If you're like most people, rhymes are a helpful way to remember important or complicated facts. Well, here's one to hum whenever you're investing. If you don't consider tax, your returns may be lax. As we mentioned in a prior lesson, taxes compounded over time can make a big dent in your portfolio. So you'll want to structure your portfolio in a way that minimizes the amount of tax you'll have to pay. Let's touch on a few pointers to get you started. The first is to adopt a laddering strategy for your income-producing investments. That means structuring your portfolio so that income is spread over a longer time frame. This smooths out the total income tax you'll owe in any given year instead of facing a huge tax bill one year and a much lower bill the next. Laddering can also free up portions of your investment dollars each year so you can reallocate them, whether that be to pay for an unexpected expense or reinvest elsewhere. Let's walk through a simple example to illustrate. Say you have $10,000 to invest in a fixed income portfolio. You could ladder your investments by splitting that $10K into 5 equal groups of $2,000. Then invest each portion into GICs of differing lengths, 1 year, 2 year, 3 year, and so on. When each GIC matures, you reinvest that money plus the interest generated into a new 5-year GIC. Rinse and repeat for however long you want. This type of laddering can yield many benefits. For one, you'll be tapping into the higher interest rate offered by the 5-year GICs. You'll also be able to access 1/5 of your principal every year to do with as you wish. And you'll have a more predictable tax bill each year with steady interest from the rolling 5-year GICs. Compare that to investing the entire $10,000 in a 5-year GIC all at once. That would see your tax bill jump after that 5th year, but be much lower in the 4 years prior. Plus, you'd have all your capital tied up with no way to access it until the GIC matures. Beyond laddering, investors should carefully consider how they divvy up their investment dollars among different asset classes. The wrong mix can inadvertently lead to a larger tax hit than expected. For example, having a high concentration of dividend-paying stocks in a non-registered account may push you into a pricier tax bracket. Depending on your financial goals, it might make sense to divert some of those funds into an asset that doesn't produce yearly income, such as growth stocks, where it's mainly taxed on capital gains. And remember, only 50% of capital gains are subject to taxes, so the other half is completely untouched. Similarly, holding assets that produce a return of capital in a non-registered account for a long time can eventually produce an unexpected capital gain. So, make sure you understand what sort of distributions you're receiving. And if you're planning to make an in-kind contribution to a charity, make sure it isn't a security with an accrued loss. If it is, you won't be able to claim that capital loss. Aside from year-to-year decisions, it's always good to think big picture when it comes to tax strategy. This can help you avoid mistakes earlier in life that come back to haunt you later. For example, sometimes the smart move is to pay taxes today rather than deferring them with an RRSP. If your RRSP becomes too large, you may face a steeper tax bill during retirement than you're comfortable with. So you may want to consider using other types of accounts, like RESPs or TFSAs as well. Here's another one. Income splitting can be a useful tool for lowering your household's tax burden. But the origin of the investment dollars matters when filing your taxes. As such, some investors like to direct the lower earning spouse's funds towards investing, while the higher earning spouse pays for other expenses. This means any investment income will be taxed at the lower marginal rate between the two partners. You can even set up what's called a spousal RRSP and make contributions towards your significant other's retirement. This sometimes makes sense for couples with large differences in their earnings because it evens out the personal income tax each person will pay in retirement and potentially reduces the total tax they'd owe between the two of them. Of course, there are so many other tax strategies to consider, far more than we could cover here. So it may be worth a chat with a tax professional to go over your specific circumstances. But for now, we hope the strategies we've shared will have you singing a more upbeat tune come tax time.